Commercial Real Estate for Beginners, The Basics, presented by Rich Valor. Why choose commercial real estate over other investments? Cash flow, depreciation tax benefits, appreciation, long-term, principal pay down, building equity, concept of leverage. The return stack. Cash flow, depreciation tax benefits, long-term appreciation, and building equity. Annual cash flow divided by investment equals cash flow ROI percentage, also known as cash-on-cash return. Divide the annual cash flow, money after all expenses and debt services, by the amount invested, down payment and any capital expenses, to calculate the cash flow ROI percentage. Example, $90,000 annual cash flow divided by $700,000 invested equals 12.86% cash flow ROI. Not bad. Depreciation tax benefit formula. Property value minus land value divided by 39 years equals depreciation tax benefit percent. Example, $1.4 million property value minus $350,000 land value divided by 39 years equals $26,923 tax write-off. Remember, your land value is 25% of your property value. In the return stack, $26,923 divided by $700,000, your investment, equals 3.85% tax benefit ROI. Appreciation. Appreciation varies in every market with every type of property. For long-term projections, let's use 5% a year. Add that to your return stack. Principal paydown. Principal paydown is the amount you pay each year to reduce the principal amount on your loan. Each year, the percentage of your payment applied to your principal balance increases, while the amount paid towards interest decreases. Let's use 1% for the return stack. Total return stack calculation. Add up the following. Cash flow ROI equals 12.86%. Depreciation tax benefit equals 3.85%. Appreciation equals 5.00%. Principal paydown equals 1.00%. Total return stack equals 22.71%. Let's talk cap rates. Formula, net operating income divided by purchase price equals cap rate. Example, 90,000 NOI divided by 1.4 million property value equals 6.43% cap rate. But it's not exact science. 3 things to evaluate for initial cap rate. Creditworthiness of the tenants. Deferred maintenance or other capital expenses paid up front. Is the current rent below or above market rate? Terms left on leases? Internal rate of return. Formula, total income divided by investment divided by years owned equals IRR. The IRR is a term investors use to look at the overall return over a given period of time. It is the average percentage of the total income, money made, divided by the amount invested, divided by the number of years you own the property. Where to start and what to look for. Start in your own backyard, not literally. Most commercial real estate CRE gurus will tell you to start in your hometown or somewhere in close proximity to where you live and work. Look for a property that is the size and type you can handle without too much risk or hassle, like a small multifamily property or retail center. Look for accelerated wealth opportunities, also known as a value add. Vacant or partially vacant, run down, rents way below market. Leases are short-term with no renewal options. Owner financing is a bonus. Back to cap rate. Find a $1.4 million property with current rents below market with an NOI of $90,000. Boost the rent by 10% to $99,000 and use the 6.43% cap rate. New value, $1,539,658. creates $140,000 of additional value, adds $9,000 a year in cash flow, increases the return stack to 24%. Leverage, the number one benefit of buying real estate. Let's compare what a $300,000 investment gets you in real estate versus the stock market. Real estate, $300,000 investment equals $1.4 million property. Stock market, $300,000 investment equals 300K stocks. Leverage continued. If the value of both, $300,000 invested in stocks or real estate, appreciates by 5% per year, you get 5% return on the value of the real estate, $1.2 million, as opposed to the amount you invested, $300,000. A 5% return on the investment in stocks would be based on the amount invested. Real estate return, $60,000. Stock return, $15,000. This is the value of leverage. Pros and cons of commercial real estate ownership. Cons. Income-producing property is not liquid. You can't get your cash out quickly. Commercial property ownership takes work to find it, finance it, acquire it, and eventually sell. Pros. Leverage is not available in stocks. Depreciation benefits not found in 401k. Cash flow every month if fully leased. Appreciation is on the value, not just the dollar amount invested. Pro tip, never sell. Why never sell? 1031 tax-deferred exchange. In the U.S., the 1031 tax-deferred exchange allows you to exchange an income property for another income property as long as you reinvest all the proceeds or buy a property of equal or greater value and use a qualified intermediary to handle the process. This is not a loophole. Don't leave it to the kids. For elderly investors, you can exchange your complex investment property holdings into single-tenant net lease, STNL properties, think Dollar General or Burger King, and leave them to your kids. Buy one for each. When you pass on, your kids can sell these at the stepped-up basis and avoid paying capital gains tax and depreciation recapture. Or they can hold on to your legacy and start the cycle over again to build wealth for future generations. This is just the beginning. Email rich@valor.us or visit www.richvalor.com to learn more.